Let's try to pick on a few topics and finish up. It's a little bit difficult sometimes to do this in a short time. As you can see, it's a lot of material. And I mentioned I do full day classes on this. I talk about this for 7-8 hours straight, and we get into all the nuts and bolts and details. So we're touching on things here and there. Hopefully, you come away with a few good tidbits. As far as 1031 exchanges, the name of the game again is if you have losses, you want to use them against other income. If you have gains, you want to pay as little tax as possible. Well, one of the ways to do that is to defer the gain until later. 1031 or like-kind exchanges are the same thing. 1031 is just the IRS code section, so you may hear it referred to as one or the other. The first thing to talk about with 1031s is that they do not apply to renovating or flipping properties, okay? So you can't fix up, sell property A, make money, roll that into property B, and then make money, and so on and so forth, and never pay tax. Doesn't work like that. So if you're dealing in inventory, as they say, you can't do the 1031 exchange. 1031 exchanges, like-kind exchanges, only work for what we'll call investment property, or basically rental property or land, or any type of what we'll call capital asset. Okay, the flipping property is not a capital asset, it's inventory. If you're dealing with a capital asset, you buy a piece of land somewhere, you let it sit for 5 years, and then you decide, I'm going to sell it, but instead I'm going to buy property B, and with the money, you can do this like-kind exchange. And the way that works is that you have a certain amount of time to identify the new property, and then you have a certain amount of time to close on that new property. So you're selling property A, there's a profit, you have 45 days to identify property B, you have 6 months to close on property B, and if you meet all the tests, what will happen is you take the profit from property A, let's just say it was $50,000, and it gets rolled into the cost basis of property B. It reduces the basis, and then you have a lower basis for two reasons. A, your depreciation is now going to be lower because your basis is lower, your starting point, and then B, when you sell that property down the road, you're going to have a higher profit because now your cost in that property B is less. Does that make sense? So you're basically deferring any tax to a later point in time when you sell the next property. Now, people do this for all kinds of reasons, but you have to keep in mind that many times you need to hire what's called a qualified intermediary. It's a third party because this is not your money. You're not really allowed to touch it. If there's any cash hitting your hands, there could be tax involved. So you have to go through the right procedures and make sure that you're doing it right in order to make sure that you're deferring the tax properly. Now, interestingly, I usually tell people if it's a small property and it's a small gain, it's probably not worth it, right? Because you're deferring a small amount of tax, you're paying all kinds of fees, but I've seen where it works. I actually had a client do it without even asking me, and then at the end of the year she said to me, oh yeah, I sold that property, I did a 1031, and I was curious about it, and I ran the numbers, and it worked. She didn't save a ton, but it was definitely worth a while. So 1031s are good. They're tools that are out there. There's something called the reverse exchange also, where you can do it the other way. You're buying it before you sell the other one. But again, those are more expensive. But there are different ways that you can do it. So if you are selling one property and at the same time buying another property, that's something to think about. The last thing, I guess, on 1031s and like-kind exchanges is that it doesn't just apply to real estate. Okay, if you have a business car, a vehicle, and you go to the dealer and you exchange it for a new car, if that car was on your business books, that's a like-kind exchange. Okay, so if there was a gain or a loss on that car, you would actually have to roll that new basis into the cost of the new car. Okay, so many times, that happens when people exchange their business vehicle.
Yeah, can you explain, I think, and I don't think you mentioned this, it has to be on an equal or greater than property than the previous.
Yeah, so thank you. So I mentioned that if you pull cash out of that deal, then you're generally going to have to pay tax. So what he's saying is that generally speaking, you're purchasing a new property at the same value or higher, not lower, because then it wouldn't work. The numbers wouldn't work. And again, if there's mortgages involved, that also comes into play, and the calculations can get pretty tedious. But it can be done, and I guess that's the main point, is that you can do it. Actually, the biggest, most famous, I believe, I don't want to mess it up, but I think way back in maybe it was the 60s, the Baltimore Colts, they exchanged player contracts or something like that with the Rams or something like that. There's a famous case out there. So like-kind exchanges apply to everything, any business asset, if it's a capital asset. But keep in mind, you can't rehab and roll the profits and defer the tax, because that's not capital.
I want to mention that the cost of the intermediary may vary significantly. It's my understanding that you can't use the qualified intermediary at the same time in the same, or for more than one transaction in the same year.
Okay. Also, there's other types of ways to defer taxes. So it's not just like-kind exchanges. There's something called a 1033, which is a condemnation. So I had a client where the city of Baltimore came and said, we want that piece of land, here's a bunch of money. They had a certain amount of time to replace or pay tax on it. Also, there's installment sales. So you can, if you sell a property and you take back a mortgage note for more than 12 months from the person that you're selling it to, the owner financing, that's generally going to be an installment sale. You don't pay tax on the full gain. You pay as you receive the money. So every time you get a payment, there's principal, there's interest, right? And then there's a piece that's going to presumably be capital gain. So those are just some different property disposition examples and ways that you might be able to defer some of the gain on capital gain when you sell property. Okay, so our next topic, let's talk a little bit about retirement plans and how you can use them, and I'll kind of wrap the self-directed discussion into this as well. It actually, there's a lot of different retirement plans out there. The first thing to keep in mind is that you can't put money into a retirement account unless you have earned income. Okay, so if you have earned income, then you can defer some money into a retirement account and not pay tax on that money yet. What I mean is, say you have a W-2 job and the company provides you with a 401k, right? Through your W-2, you can put away a certain amount. Sometimes the company will match, and you don't pay tax. Your W-2 box 7, which is your taxable wages, will drop because you put $10,000 away into this retirement account. And then the company will put some in, and then that money will grow tax-free. Typically, they have you in mutual funds or stock market or what have you as the investment. If you don't have earned income, you can't put money away against that income into a retirement account. If you earn interest income, you can't put money away against that income into a retirement account. If you are renting properties and that's all you're doing, that's passive. Okay, so again, see how everything comes back full circle. We talked about rental income being passive. It's not earned income. You're not paying Social Security tax on it. So you can make $1 million renting properties. You can't put, generally, you can't put away any money against that, save for retirement. So what kind of income then are we talking about that you can? What's earned income? Well, we said from the very beginning of the evening, we said renovating properties, real estate agent commissions, right? If you're wholesaling, any type of ordinary activity in real estate that you're generating self-employment income and you're paying self-employment tax, now you have the opportunity to put money away into a retirement account. Now, keep in mind that we already said that therefore LLCs are perfectly fine, or even just owning them in your own name, for rental properties because they're passive, there's no extra tax. And there's no play when it comes to retirement savings against that either. But now let's look at the other side. What was the general best entity to use for the real estate commissions, for the renovating of properties? The S corporation. Why? Because it's earned income. You're paying extra 15%. And the best thing to do in many cases is to pay yourself a W-2. Right? Remember our example where you made $100,000, you paid yourself $40 on a W-2, and you saved 15% on the 60. So you saved $9,000. Well, now you have earned income, and now you can put money into a retirement account. So there's different types of retirement accounts. There's IRAs. IRA, you could put away $5,500. If you're over age 50, you could put away $6,500. Then there's something called a SEP. A SEP is basically a self-employed person's pension account. You can put away about 20% of your earned income. If you make $100,000, you could put away about $20,000 into that SEP. There's another one called a solo 401k. Now, it used to be that only companies had 401k plans, and IRS said, finally, Congress said, this isn't fair. I work for myself. I don't have a big fancy Fortune 500 company. Why shouldn't I be able to put away the same amount that those guys are able to put away? So they came out with these solo 401ks, which is just you, and now you have the opportunity to do the same as if you're working for a big employer. Now, how does that work? You can put an employee contribution into this retirement account, into this 401k, and the amounts are set, $18,000 per person, and if you're over age 50, you could put away $24,000. Then the company can match. The company match is 25% of earned income. Now, if you make $100,000 and we pay you a salary of 40 is your earned income. The 60 is not. Okay, it's only the 40 that's the earned income. You could still, as the employee, put away the 18 or the 24, depending on your age, through your W-2. So you would pay yourself 40, right? And through that, you would make this contribution to your retirement account. So instead of showing 40,000, if you put away 18,000, your W-2 taxable wage would be the 40 minus the 18. So you save you save that on your taxes. The company can then match 25% of your earned income, which is your W-2, which was 40, right? So a fourth of 40 is $10,000. So you could put away 18 plus 10, 28, or if you're over age 50, it's 24 plus 10, 34,000, and save that and put it away into your retirement account and save and not pay tax on that money. It goes into your retirement account. So you see how, depending on the type of investor you are, depending on the type of activity and tax you're generating, also plays very nicely into, besides what entity you're using, but how the retirement works. Does that make sense to everybody?
Yeah, let's do a real life example of this as well. So let's say you're an investor and you have a single member entity, a one-man entity, one-woman entity. You make $100,000 flipping a house or whatever, $100,000 net flipping a house in the first year. You set up a SEP, right? Because that's, and let's say, how much can you put away?
20%.
You can put up 20%
Roughly.
in a SEP, into like a traditional IRA, call it. Meaning you put up that $100,000, you make $100,000, you put up, and most people say, well, I have that $100,000, I want to use it for this, I want to use it for that. Well, you put that money into that SEP, through that traditional IRA, and all of a sudden, now your tax basis is $80,000, and you have $20,000 in this account, and now you're paying taxes on that $80,000, not that full $100,000. I mean, it's kind of a no-brainer. I talked to a lot of, we match the crap out of every one of these retirement accounts that we have. We have employees, so we can't do a SEP. I think it's like defined contribution plan or something, 401k.
You can't do a solo 401k if you have employees.
No, if you do have employees, whatever.
Well, if it's a company, you can start a company 401k.
Whatever it is. But, the company, we put up the max of what we can in a traditional IRA. Why won't I? It's absolutely, it's coming right off the top line. Like, it makes no sense not to, and then the company matches its certain amount, which comes out of, I guess, just as an expense, right?
Yeah, so imagine...
Which comes out of my end anyways.
Right, and imagine what we said earlier. Let's say you're in a 25% tax bracket. And so you're paying 25% federal plus another 15% Social Security, that's 40, plus 7.5 to Maryland. You're paying almost 50% tax. So every dollar that you put away into a retirement account, you're saving half of that, right? So instead of giving it to the IRS and Uncle Sam, you're giving it to yourself.
I mean, it's a no-brainer, and I think a lot of people don't kind of think of it like that. They think, hey, I start my own company, then I don't work.
You have to have the cash.
Yeah. But it's still, listen, as soon as you put it into that, the next thing you know, then you can, we can talk about self-directed IRAs.
Okay, I was out to.
It's the next step.
That's right.
You roll that money right over, and now it's liquid and put into deals.
Exactly right. So most people say, well, I don't really have the cash to put away into the retirement account, so it's wonderful that I'm saving the tax, but now I got to pay tax, even though it's less, plus put all this cash away into the retirement account, it's too much. But the answer could be the self-directed. So if you put it all into a self-directed account, basically then you can turn around and use the money to do another deal. And the money is is in your retirement account. So instead of investing in the stock market, right, you're growing hopefully this money tax-free for your retirement through the real estate activities. And I have 2 of those accounts myself. I have clients that use that to lend. I have clients that are renovating in there. I have clients who have rental properties in there. I have people doing all kinds of things. And when I first learned about them, I called one of the big companies called Equity Trust Company. I called them up, and the guy who answered the phone told me that he used to work for the IRS. And I grilled him. I was trying to figure out, how can we take advantage of this? And basically what he told me was, as long as all the money that's made off of that retirement money goes back into the account, you can pretty much do, not whatever you want, but you can do a lot. So you can, for example, take $50,000 of your own money, $50,000 from your IRA money, start a company, put all that in, and then use that money to fund the deal. Now, there are some things that you have to be aware of, and there's one, the main thing is called self-dealing. You're not allowed to do any self-dealing. You can't pay yourself a management fee. People try to, they're trying to take advantage, and I get this question a lot, right? So I'm doing this deal, my IRA is putting in half, I'm putting in half, but I'm managing it, so I should pay myself a management fee. You can't really do that, okay? And if you buy a property that's owned in your retirement account, you're not allowed to live in it, your family's not allowed to live in it. There's a lot of self-dealing rules where the IRS says this is not your money, this is trust fund money, you can't touch it, you can't have any benefit from it. But if you do it right, it's totally legal. The other quick point on that is, if you're borrowing money using IRA money in a deal, you have to be very careful, because there's something called UBIT, which is unrelated business income tax. And an IRA is not allowed to be on the hook for debt. And so IRA can't go borrow money and be on the hook for that debt. If you do that, you could blow the whole exempt status of your IRA.
Don't you just pay taxes based on the leverage piece?
If you do it right, you would do a ratio and pay tax only.
Yeah, so we do loans to IRAs.
It has to be non-recourse.
Yeah, absolutely. But
you do that?
The right LTV, I don't care. Right? For instance, a lot of lenders do not do non-recourse loans, and your IRA obviously cannot personally guarantee it, and then you personally can't just personally guarantee on behalf of your IRA.
Right.
So we're one of the lenders that we're happy to do a non-recourse loan and lend money to an IRA, and the reason why is, and this is more of a business decision than anything else that we came up with years ago, is, for instance, if we typically would lend somebody $65,000 on a $100,000 asset with a personal guarantee, I would rather lend them, or I'm willing to lend them $40,000 or $50,000 at a lower LTV without a personal guarantee. So it works great for IRA. So let's say your IRA has 50 grand, you buy a $100,000 property, we'll put up 50 grand, the IRA puts up 50 grand. The IRA is the owner of the property, and all the proceeds from that property have to go back into the IRA, so it can't come into your personal name. And there's obviously nuisances with buying stuff in an IRA. It's a little bit clunky. For instance, you need to pay a contractor for construction work. Well, you can't personally pay that contractor, the IRA has to. And guess what? You can't sign on behalf of your IRA on some of these places, like Equity Trust, for example. So you got to send the loan package, and they have to sign on behalf of it. So it's all doable. There's other companies like Security Trust, and I think even Mid-Atlantic, and they're both in Frederick, Hagerstown area, but both of them, they have something called checkbook authority, and it's a little bit more flexible, but double check depending on what your situation is. But the important part is it gives you the ability, and one of the things we always talk about when we do videos and stuff at Hard Money Bankers is there's a lot of people that may not have, you know, the $40,000 or $50,000 in cash that they need to get themselves into a deal, but they do in an IRA or some sort of retirement account that they can roll over into a self-directed IRA.
Yeah, and again, I deal with a lot of people that are doing this, and it's very hard to find somebody who will do non-recourse loans. So,
I mean, why not? Lower
Yeah.
LTV. What's the difference? A personal guarantee is not worth, 20% of a piece of collateral, usually.
okay, so to finish off, a few more minutes, let's talk a little bit about just a couple of new things that have been out over the last few years, and then, I know it's only July, but just a few things to think about between now and the end of the year. The biggest thing is called the net investment income tax. So under the Affordable Care Act, which was President Obama putting out to pay for all the health care for everybody, part of the way they paid for that was they added a tax called the net investment income tax, which applies to people who are making what they call too much money, and it applies to any of their passive income. So if you're making too much money, I don't have all the numbers in front of me, but I think it's about $450,000 if you're filing a joint return, then you're going to pay an extra 3.8% net investment income tax on all your passive income. So if you have rental income, you're going to pay tax on that. If you have interest income, capital gains, whatever it is, you're going to pay extra tax on that. It's also additional 0.9% Medicare. So if you are taking a W-2, or even if it's your day job, you're going to pay some extra tax on all of that under the Affordable Care Act. So that's a big thing that they put out a few years ago that applies to real estate investors. The other thing I want to mention, we'll save the questions for the end. The repair regs, this came out a couple of years ago, and they basically, I don't want to get into the details, but they changed how the IRS changed how they're going to look at repairs versus capitalizing. So we talked about depreciation. Well, let's say you have a roof that has a leak, and you have to spend, let's say it's a small amount of money to fix it, or your HVAC, something happens to it in the house and you have to spend some money to fix it. So not so simple anymore that it's just simply a repair and that you can write the whole thing off as an expense, as opposed to having to capitalize it and depreciate it over a number of years. There's a big difference there. So those rules changed. Again, I'm not going to get into all the details on that. Employee versus contractor, we talked a little bit about giving 1099s and how strict the IRS is getting with that. The IRS.gov has pages, you can look in there and you can see what they call an independent contractor, what they call an employee. Basically, if you're guiding the person when they're supposed to come in, what they're supposed to do, you're supposed to give them a W-2. IRS wants to put the onus on you, and not that they should have to chase people down because you paid them and you either didn't give them a 1099 or they gave you bad information, and then they have to get stuck chasing them. If you don't do it, they can come after you and make you pay their tax. They do that by denying the deduction, like I mentioned before.
What about for contractors out there that use one certain sub, and that one certain sub exclusively works for them?
Well, from an employee versus independent contractor, it's the same rules as IRS, it's federal rules, as long as you're not controlling when, what, where, etc. That's generally what they're going to look at.
You can be in that particular.
You might be, yeah, you might be.
I mean, I know independent sales agents make it tough between commission, commission and W-2. And I just, I don't know the answer to this. I was just thinking about this. But for instance, I own a home improvement company, and whatever, I do renovations for whoever, investors, and I have the same sub that just, maybe handyman work, does all of my stuff, and he works full time, and I pay him every Friday. I mean, is that, does he, who knows, but.
Yeah, I can tell you one thing, to change it on you a drop, I've had Maryland unemployment audits. So you only pay Maryland unemployment on employees and wages, but if they audit you, they will come in and they'll make you pay unemployment tax on all of those people. And I've had it happen, and they want to see, does this company have a website? Do they have business cards? Are they advertising? If not, and the answer to all that is no, which many times it is, they'll say, for them in particular, you have to pay it. And I have a mover who that happened to. They audited him, and he just pays guys cash to help him move stuff. And none of them had business cards or advertising, and he has to pay unemployment tax on all of them every year.
So they qualify them as employees.
But it's the state that so what I'm saying is there's a difference between federal and state. Maryland will qualify them as employees. It doesn't mean that for federal that you have to pay give them a W-2. Just a few things to think about, again, between now and the end of the year. So we talked about the entities. We talked. I would, urge you to look at your assets to see whether you're depreciating things properly. You can always, bunch expenses into this year as opposed to, charge things before the end of the year. Those types of things to grab expenses. If you're doing deals and you want to defer the income, is it towards the end of the year? Can you push it into January, for example, on the income side?
And actually, let me add, just from business experience, one thing that, and I've talked to a lot of investors related to this. A lot of investors that are set up as entities or as LLCs, and they take K1 money distributions, and all of a sudden, let's say at the end of the year, they have $30,000 left in their operating account. They either take that money, or they don't take that money, but at the same time, that $30,000, they're getting taxed on a personal level. And that's one thing that a lot of people don't, I think, 100% realize. Like, you look at it as, I don't get taxed on that money until I take it out, but technically that's not the case. You take it out or you don't take it out, you're still getting taxed on that money as an LLC, which, like you said earlier, the majority of all of us are set up as, just because it's so popular. So at the end of the year, take it or don't.
Right. A couple other things just to think about, like we talked about your hours, and if you're a real estate professional, just give that some thought as to what your activities are and how much time you're spending on things, and whether you should be keeping logs. People ask me all the time, should I log it? I'm driving, should I log it? Again, you're supposed to. Let's just say that, right? There's tax credits. There's certain things, if you're doing certain kinds of rehabs, just to be aware of that you can take. And I do a lot of multi-state work. Jason and I were talking before about, the folks in Virginia and what have you. But I mean, I have clients doing real estate all over the country, and a lot of them took a lot of these different educational, courses, and they're setting up entities all over the country. So, again, I don't want to get into that, but I have a lot of thoughts on all of those issues as well. Finally, I think the last thing is the bookkeeping. It's very, very important to make sure that your bookkeeping is in order. I can't tell you how much time we spend and waste. And the biggest problem, besides for you as the business owner not really knowing what's going on because the books are in shambles, for us as the tax preparers, and we got to figure it all out and sort it, and it takes away then from the ability to do all the proper tax planning because we're too busy trying to figure out what in the world is going on. So it's a domino effect when your books are not in order. I had somebody in my office, a prospective client this morning, and everything's in Excel. They're like, well, should we use QuickBooks? How do we get all of our Excel stuff into QuickBooks? Well, it's not that simple, right? And they have different jobs, and in QuickBooks, you can run classes, so you can have all of your properties in a class, and then you can run a nice, pretty report anytime you want, and then you can see where your company's holding. You can compare columns, property A, property B, property C. Hey, why are my utilities on property A twice what they are on property B? These are the types of things that you can do when you're keeping good track of everything. It's not easy. Most business owners are not bookkeepers. They don't understand accounting. I said to the guy this morning, well, you can make a journal entry from Excel into the QuickBooks. And I kid you not, he looked at me with the blankest stare and he said to me, what's a journal entry? And my first thought was, uh-oh, but I get it. I talk to a lot of people, and I can't fault him. It's not his profession.
Yeah, I mean, like Chris said earlier, if you can't count the money, you can't really be in business. And because of real estate, the one disadvantage of real estate is bookkeeping's harder. Most businesses straight income and expense. It's much harder. The majority of it in this, there's asset and liability, and talking to a lot of people that own a lot of real estate, they still don't fully get it. So
In our firm, we do a lot of monthly bookkeeping for regular, ordinary businesses. I always hesitate to do the bookkeeping for some of the real estate folks. One of the reasons is because they're ultimately going to have to sit down with us and go through every line anyway. So then it's like they feel almost like, well, why are you doing this? We're doing it with you. But that's you have to do it that way because there's so much going on.
And going back to it from the beginning of why you should, spend the time, and you don't have to be an expert at it, but learn it and at least understand it on a high level. Because forget the part of if you don't even know where your money is, it's going to cost you so much darn money just to unravel everything you're doing. The longer you wait, the longer it's going to be. I mean, how do you go back, let's say you flipped 5 properties in 2016 and you're working on your books to file your returns in 2017. How the heck do you remember what everything was that you did? You can't, it's impossible.
All right.
You want to ask a question real quick, Ian?
All right, questions?
We'll wrap it up.
No, I was just going to go ahead. You're good, go ahead.
Earlier you were talking about flipping houses being regular income. Why isn't it considered capital gains?
So the IRS, okay, so everyone heard the question, why is flipping houses not capital gains? It's a good question. And I'll tell you that in the webinars that I've watched from some of those national guys, this is one of the things where they stop short of telling you the truth. And they want you to think that, oh, maybe your accountant's doing it wrong, okay? And the answer is as follows. The IRS says, I say IRS, it's Congress, it's the statute, it's the law. The law says that your intent is what will determine the nature of what you're doing, okay? So if you are in the business of rentals and you pick up one property and you put a little money into it and somebody comes along and makes you a great offer and you sell it, you can argue that your intent was to keep it. This is my business model. Happens to be that I veered off of it one time. And my feeling is you can do that. You can get away with that. But let's say it's not really your business model. Let's say you don't own any rental properties or you own one and you start to renovate and rehab and sell, and time goes by, and maybe in the first year you only did one, but then your plan was to do it, and then in the second year you did maybe 3, and then in the third year you did 6, and the IRS has 3 years to audit you, and the IRS comes in and does an audit and says to you, how come in year 1 you told us that was a capital gain? You made $100,000 renovating that property, and you only paid us capital gain rates at 15%. And we don't like that. And you say, well, my intent was that I was going to hold that property, and so therefore it was a capital gain. And then they'll look at your track record for the last 2 years and see that in year 2 you sold 3 or 4 properties, and then in year 3 you sold 6 or 7 properties, and this is what you're doing, and they will tell you that they disagree. Right? So it does come down to intent, and there are times that you can renovate a property and it can be a capital gain, and people are aggressive with it. I'm aggressive with it when it makes sense, but the rule is that it depends on what your intent was.
Let me add one thing real quick, because I don't think we talked about this earlier when related to short-term or long-term capital gains and tax rates for ordinary income. I mean, the big thing is if you're paying short-term capital gains or ordinary income, that's your ordinary tax bracket, which is gigantic. Yeah. If you're paying long-term capital gains on some of these rental properties, it's what, 15 or 20%? Right. I mean, it's half. So there's a huge difference.
Yeah, but if it's short-term, let's say you flip a property over 6 months, you're paying short-term capital gain, that's ordinary rates, but you don't pay the self-employment tax. True. That's really what you're saving.
Earlier we talked about the bifurcation between S-Corp versus C-Corp. Can you talk about that in relation to some of the folks who, besides having a business, have a day job where they make enough money? Because I think there's a bracket where if you're trying to get benefits of an S-Corp, about a certain amount, depending on what your other personal income is for your day job, they say it may not make sense. Can you elaborate on that? You get what I'm going with this? So,
you mean you're putting your day job money into the company?
No, so I'm saying on your day job money, which comes with W2, you're already making a certain amount of money. Right. Then with regards to your S-Corp, as far as the tax benefits go, I think it's number, I think it's around 40 grand or so. If you're not making less than 40 grand from your business, it probably doesn't make sense for someone who's saying maybe on your day job you're making about 100,000. Can you talk about that a little bit more?
I'm not sure I understand the question. You're talking about the fact that the C Corp has its own tax rates and they might be lower?
Right. So that basically, because when you combine that with your income from your day job, W-2, it might, depend on what your situation is, it might not necessarily benefit you.
Well, your W-2 is going to go on your personal tax return, and you're going to pay ordinary tax rates on that regardless. If you have a C Corp and you keep the income low enough, C Corp rates could be lower than the personal rates. That's one of the things that the current president wants to change. He wants to make it that any corporation now is going to pay a lower tax rate, which would just really make it that everybody's going to go out there and become, corporations. But there could be a possibility, depending on what you're doing and what your numbers are, to make that work. But for the most part, if there's real estate owned in a C Corp, your appreciation is trapped. Because if you buy a property in a C Corp for $1,000 and 40 years later it's worth $1 million, you're going to pay tax on when you sell it, and then the company, then to get the money out, you got to pay tax again.
Are you going to touch on the tax credits, maybe low housing income tax credits or new market or even renewable?
I can talk to you about that afterwards. I wasn't going to go into it now. I don't think we have time for that.
Yeah, are you be around right afterwards? Go ahead.
Question for you. Something I've wondered, going back to the business entity comparison conversation. Is it possible in accounting and tax prep software to run models based on, okay, your company, let's look at it as an LLC, as an S Corp, as a C Corp, and kind of side by side compare? Is that available? Is that available?
It's not available, to the best of my knowledge, in the actual tax software. But I have a client in Virginia who came to me, and they had several businesses, and 2 were LLCs, and he was 50, they were 50-50 in each. He was the active one in the one, she was the active one in the other. Their whole goal was to put as much into retirement as possible, and basically I used a tax projection software, and I ran them a couple of scenarios. One in particular showed LLC versus S Corp and how I could save them money and play between the two, and potentially manage the income in each company, so to speak. And by doing that, maximize the tax and also maximize the retirement contribution.
That sounds like what I was saying. Maybe not in the tax prep software, but in some like projection.
It can be done. I do that all the time. It's time consuming because you're late. Yeah.
On the self-directed IRA, I have a Roth, a SIP, and a SEP. Can I only use one of those in particular?
There are year maximums, so you're not allowed to put more than the annual max at all.
You mean for a deal?
Right, but I'm saying for a transaction, say if I have a pool of money.
Oh, you can use different ones, sure.
I can use that one of them.
Yeah, I thought you meant putting it in.
And let's say you have, whatever, 50 in each one, and you want to do a $150,000 deal.
Yeah, depending who your custodian is, it might not be simple, but you can do it. Legally, you can do it.
Legally,
yes.
I mean, if they're all the same custodian.
Ultimately, you want to try to get you a Roth, so you don't have that.
Can you roll money from the government for savings?
Yes. Yeah.
Any amount? Even if you're not retired?
I mean, I shouldn't say that. Different plans have different rules. It is governed by the plan.
Some government plan.
Yeah, it is governed by the plan. But if the plan allows for it, then you can do it, sure.
And to answer your question, the goal should be to
right, but she's saying she has it in different already.
To try to get it into a Roth.
Right.
And it depends on the size of it, though. I mean, if the size is too big, you don't want to pay the income on it now.
Right.
I mean, 3 TAVRs or whatever that is, or your regular IRA to the Roth, you take that because it's really keeps your money.
You pay tax on it, but you can.
Right, and then you've got it clear.
And if I mean, if it's a small amount, you absolutely should do that now. And a bigger amount, it's a financial decision if it makes sense to pay the tax or not, based on how you project to grow.
Okay, well, thanks for having me. I'll stick around for questions. There's some business cards on the table here, and my information's on the outline.
No, thank you. We certainly appreciate it.